Hi, this is John Coumarianos for Real Investment Advice. It's been an interesting month or so in currency markets. After dropping at the beginning of the year, the US dollar has shot up now in the last few weeks, and this has had a few knock-on effects. The first one is that US investors in foreign stocks have had a little bit of trouble lately. You can see from this chart, you get two returns from owning foreign stocks. You get the return of the stocks in their local markets. You get a second return, which is the return of that foreign currency versus the US dollar. And when the US dollar is appreciating, the foreign currencies are depreciating, and you're suffering a little bit from getting that effect because you own, in effect, the foreign currency. You can see that clearly in this chart. If you owned developed country foreign stocks, you haven't done so well this year. You're about flat. If you own those foreign stocks with a currency hedge that takes away the exposure to that foreign currency, well, you've gone up a little bit. You've gone up a little bit. The blue bar here is the month-to-date return, and the yellow bar is the 3-month return. This series of bars shows emerging markets. Same effect. If you own the stocks in there without the currency hedge, you've done worse than if you own the stocks with the currency hedge back to the dollar. So being hedged back to the dollar has helped. A lot of investors don't know that you can own funds with currency hedges, so you can have that foreign stock exposure with a currency hedge without suffering the foreign currency exposure. iShares, I talk about it in my article on the website. The iShares family and the X-Trackers family both have a whole suite of foreign stock funds that don't give you foreign currency exposure. They have hedges on the exposure. The second thing to notice about the boost in the US dollar is that it has really come from a rise in US interest rates. And that has actually had a beneficial effect on short-term bond funds. I selected a fund that's really an ultra short-term fund here. It's just maybe half a notch up from a money market in terms of risk, both interest rate risk and credit risk. This is the PIMCO Enhanced Short Maturity Active ETF, clever ticker symbol MINT, M-I-N-T. The three yellow bars here show the 1-year return of this fund, the 3-year return, and the 5-year return. And they're all below 2%, with the 1-year return being the best one at a little bit above 1.5%. This green bar here, though, shows the current 30-day SEC yield, and we took it off the PIMCO website today, and it's 2.19%. So that's what this fund is going to be yielding in the future, going forward from today. And that's at least one beneficial effect from interest rates rising. So thanks for watching. This is John Coumarianos for Real Investment Advice.